Ladies and gentlemen, welcome back to the channel. So I had to do something that was pretty sad today. I had to sell my SOFI stock, sell all my shares, sell all of my options because, you know what? It's April Fool's Day. Yeah, I'm just playing with you guys. It's also my birthday, so I had to do it to all you guys. That is not an April Fool's joke. So it's time to get into a SOFI stock update. Come for the SOFI, stay for the April Fool, subscribe because you want to, and like the video because it is Friday. Nonetheless, it is time to get into a SOFI stock update. All of the April Fool's jokes aside, SOFI stock was down 1.27% today, up 0.32% here in after hours, and we need to talk about it. But first, let's talk about the sponsor of this video, which is Moomoo. When you deposit $1, you will get 3 free stocks as well as an additional free share of NEO upon your $1 deposit clearing. So that is almost virtually free money. I personally use the brokerage as well as multiple other brokerages for full transparency. In my opinion, it's good to have money in multiple different places. So if you ever don't have enough money for a trade in this portfolio, you go to that one, so on and so forth. Now, let's get into all of this key information and let's build off of the video from yesterday. We had that data that was coming out today that was going to be a big catalyst for SOFI stock, and it was. But it's interesting what came out with that data. So we've been paying attention to the non-farm payrolls as well as the unemployment rate. The unemployment rate actually came in a little bit under expectations, were a little bit better than expectations. It came in at 3.6%. It was estimated to come in at 3.7%. So that's good for the overall economy, but it's not so good for the outlook of the Fed's rate hike cycle. If you start to give the Fed reasoning to raise rates faster, like the unemployment rate going down even more while inflation is high, that's what the Fed is going to do. You're not really giving the Fed a reason as far as unemployment rate to not raise rates as aggressively as 9 or 10 rate hikes this year as the markets are pricing in. Now, non-farm payrolls, that was a little bit on the bullish side for the markets, coming in at 431,000 jobs. We were expecting 490,000 jobs. So a little bit of good and bad, kind of neutral overall. That's why you really didn't see a big move one direction or the other with the markets. But I will tell you, the federal funds rate projection went up again today for that 0.5% rate hike coming on May 4th. And that is 4 weeks, 4 days, 21 hours, and 34 minutes away. The probability for a 50 basis point rate hike, or a 0.5% rate hike if you don't understand basis points, 0.5% rate hike was at 70.5% yesterday. Now it's at 72.7% for the day. So that is not good for the markets, but the markets are really shrugging this off for now, and it's likely due to the amount of time we have until the Fed rate hike decision. So there's a couple ways this is actually going to play out. Really 2 ways in my personal opinion. Either we rally into the Fed meeting and we're getting down to maybe a week away from the Fed meeting, and then the markets start to say, hey, we're about to get a 0.5% rate hike, maybe we need to tidy up a little bit, and you might see some profit taking a couple days before the Fed meeting. Or we rally into the Fed meeting and the markets really disregard how hawkish the Fed is going to be, and then they hit us with a lot of those hawkish statements, and then you see the markets falling afterwards. Now, if the markets fall a couple days before the Fed, and you really start to see that 0.5% rate hike be priced into the markets, then you're probably going to rally after the Fed. So those are really the 2 ways I see this playing out. The markets are not going to pay attention to this as much until we get down to a couple days until the Fed meeting. That's what it's looking like right now. Even though the probability for a 0.5% rate hike has went through the roof, now it's more likely than not. Since the last Fed meeting, which we weren't even thinking about a 0.5% rate hike, the markets have kind of disregarded that as something to pay attention to down the line. Now, as well as that, we did get the 5 and the 30-year yield curve inversion, and it's going quite dramatically. It's pretty much going straight down. And that essentially means that you will get paid more interest for lending out your money for 5 years rather than 30 years. Think about it. If you lent out $1 million, would you expect to get paid more out in 5 years or 30 years? Well, if I put $1 million up for 30 years, I'm going to want to get paid out much more 30 years from now rather than lending that out in 5 years, right? Or in theory, that's what it should do. Or really, if you're taking a loan out. You could look at this multiple different ways, but you should always get paid more the longer you lend money out for. So if you start to see that invert, and now you get paid more for lending out money for a shorter term time frame, Not a good thing, and it is not a good sign for the economy. And that is inverted by about 0.05% as of right now. So it's small when you're talking about inversions, but that is likely to continue as well. You're also seeing that 2 and 10-year bond yields that are inverting at a quite rapid rate as well, and it's actually 10 basis points, the inversion between the 5 and 30 yield curve. So that's getting pretty damn big right now. That's about 0.10% if you guys are, again, unfamiliar of basis points. So definitely not a good sign for the markets, but I will point out as well that the markets, when you get that first yield inversion, yes, it is a bad sign, a bad omen for the markets here in the next couple of years, but the markets see the best returns once the yield curve actually does invert. That would be '06, right? You wanted to be in the stock market in real estate in '06. You didn't want to be in end of '07, '08. That's when you wanted to get out. As well as that 1998, yeah, you would have missed the whole dot-com bubble. 36% gain in the S&P 500 if you sold out when the yield curve inverted. Multiple other times where the average increase to the S&P 500 is about 20%, roughly about 1 year after the yield curve does invert. So historically, you get paid out a lot, but you're going to see a recession sometime down the line. So that's the way to think about it. It does not mean the stock market is going to crash. It means we're going into a recession eventually, usually around 1 to 2 years after the first inversion. If we're getting the first inversion now, that's going to be, March, April of 2023 or even 2024 when you finally do see that recession. But until now, and then you're going to see a lot of gains in your portfolio. And I also want to point out the fact as well, when you see recessions, that means 2 consecutive quarters of declining GDP growth. So if GDP is declining, actually, it sounds like this shouldn't be the case, but it actually is. When GDP is declining and there's no growth in the economy, investors look towards stocks that are growing a lot. And SoFi is honestly growing a lot more than a lot of other stocks are, at least that are not micro caps, not small caps, stocks that investors could actually invest in if you're investing other people's money. Hopefully that makes some sense. SoFi should be primed to benefit if this recession does come, as long as lending does stay strong. Who knows exactly if that would happen? All recessions are going to be a little bit different, but that's really what you guys need to know as far as right now. Let's get into some specific SoFi data like the short interest and the option flows for the day. Now for the day, you're seeing 3 orders totaling $22.52,000, positive order value of 0%. And I want to point this out, $22,000, $22,500, not a lot for a days of trading for SoFi stock. 0% option value. That's probably due because it's been a very slow week overall. The volume has been very, very low. Besides yesterday, the last 20 minutes of trading, that was one of the lowest volume days that we have seen all year. Today, I believe, is the lowest volume day that we have seen in the S&P 500 all year. So keep that in mind. It does not mean all too much. As far as the short interest is concerned, let's go ahead and pull this up. Short interest of free float, 16.53%. Current shares that are sold short of 119.12 million. Cost to borrow max of 4.33%. Utilization of 100%. And days to cover at 2.72. So the situation here is still looking incredibly bullish. Once there is a reason for shorts to cover, you're going to see that explosion to the share price to the upside. And that is inevitable. It is only a matter of time. Now, for the max pain for this upcoming week, April 8th is next Friday. That is $9.50 per share. So that's basically where we are right now. I believe we're, about $9.35 per share, so that would be a little bit of an upside move, but nothing too crazy. Now, as far as the key levels, still $10 per share. That's going to be the key here. You are still seeing the MACD that is bullish as the RSI has continued to go down and even started to flatten out under that neutral level at 50, and this is a weird divergence where the MACD is still bullish, not really going down all too much, but the RSI has went down. So there's something that is going off here, and I do think we will see that move above $10 here very, very shortly, to be honest with you guys. I don't think it's going to be a long time that we're sitting under 10, and that's why I feel very comfortable buying SoFi stock under $10. And inevitably, here in the short term, we will bounce above 10, and then I don't think we're going back down under that for quite a while. Not any more institutional buying as well. I wanted to take a look at that. Nothing else to report on, but that was a lot of buying that was done in a very short amount of time. So that, in my personal opinion, is a good glimpse into what SoFi is likely to report coming on their earnings. Now, the volume for SoFi stock as well has been very low. Yesterday at about 33.7 million. Today only at 29.4 million shares that traded hands. So it has been a very, very slow last couple of days as far as the volume is concerned. Share price, like I said, at $9.35 per share. 50-day moving average at $10.82 per share. We're kind of hanging out right under $10. Once we break out above 10, that's where things get crazy. Like you guys have seen over this past week, you have got those breaks above 10, and then the stock does tend to run. Like you see right here, we hit $10.57 per share, got rejected off of this 200-day moving average on the 4-hour candlestick chart, and then came right back down to this really neutral level in between $9 and $9.50 per share. So watch to see if we can break out again or if we will head back down to the downside. I would definitely watch the $9 level as a key point. You guys can see a couple touches in here around $9 per share, and we always have bounced back up besides this fear move right here. So that is pretty much going to be all for this video. Thank you guys for tuning in. Like the video, subscribe to the channel, comment down below any comments, questions, or concerns that you do have. Thank you for watching, and you guys enjoy the rest of your weekend, and I'll see you in the next one.